Hey guys, welcome back to the channel. Today we'll be taking a look at Candlesticks 101, the essentials that you need to start understanding how to read candlesticks and how that help you on your journey to start your technical analysis journey for trading. So candlesticks are the fundamentals of how a lot of TA is done. And so it is quite essential that we understand how to read candlesticks. And today I'll take you guys through the whole end-to-end about how to read a candlestick and how to interpret a candlestick. So first and foremost, why candlestick? Candlesticks essentially tell you what happened during a certain time period. Did the price go up? Did the price go down? And more importantly, how did the price go up and how did the price go down? Was it a large move up or was it a small move up? That type of information can be salvaged from candlesticks, and you'll see later on in this video about how they show it. But that's the main gist of it. They show you a lot of information about what transpired on that one stock or security that you're trading over a certain time period. But more importantly, like I alluded to, it shows you the emotional or psychological context over a given time frame. Was the market really strong? Was there a lot of fear? Was there a lot of greed? Was the market indecisive? It helps you understand the context of what's happening on the market. And this, in conjunction with other indicators or other patterns or other candlesticks, can tell you a whole lot about what the market is feeling in that time frame. And so today we'll just walk you guys through how to understand and read candlesticks and what they're trying to tell us by interpreting what those candlesticks are implying. Now, one question that people sometimes ask is why not a line chart? This is a QQQ line chart, right? It's gone up here, it's gone down, it's gone up, it's gone down, it's gone up. It's basically just what the price point closed at on a day-to-day basis. Not a whole lot of information. Now take a look at a candlestick chart of that same graph overlaid, and you'll see this has a lot more information. It has a lot more of data, if you guys know how to read it, about what is going on in this chart. It doesn't only tell you if it's gone up or down over a certain time frame. It also tells you what has transpired on a day or a minute or 10 minutes. This is why candlesticks, in my opinion, are very, very essential to not only know how to read, but know how to interpret. So TA, in my opinion, technical analysis starts with candlesticks. So let's start with understanding how to read a candlestick. First and foremost, candlestick comes in basically four main parts: the open, the close, the low of the time period, or a high of a time period. And so let's start with how to read it. The body and the wick. The body is basically the fat part. Here's where my cursor is. The wick is the line. And so we'll just start on the left-hand side here, the green candle. So essentially, for a green candle, the open is the bottom line right here. The close is the top line right here, right? This implies that if I opened at $100 and I close at $102, there's a $2 increase. Therefore, it's gone up. That's why it's green. It's a bull candle because it's gone up over a time period. This is the body of the candlestick. If it was a daily candlestick on the day, the market opened at $100 and it closed at $102. Now the wick is essentially how far the market has moved up or down on a given time period, but it didn't close there. So let's take this for example, the low of $98 and a high of $104. So what could have happened here is the market opened at 100, it went all the way down to 98, and then it went all the way up to 104, and then closed at 102. It could have also done this. It could have opened at 100, went all the way up to 104, went all the way down to 98, and then it closed at 102. It doesn't tell you exactly how the price moved specifically on a certain time period, but it does tell you that this is open at 100, it went all the way down to 98, went all the way up to 104, and closed at 102. So that's the most important part. Now let's take a look at a bear candle. Opened at a higher price point than it closed, red, usually indicated in red. So here, it opened at $102, it closed at $100, it went to a low of 98, and went to a high of 104. So the two scenarios that could have happened is it opened at 102, went up to 104, went down to 98, closed at 100. Another way you could read this is it opened at 102, went down to 98, went all the way up to 104, closed at 100. But this is essentially what's telling you the highs and the lows in the market and where it opened and what it closed. So two parts, body and wick, four main information gathered: open, close, high, and low. Now, just to recap, a bull candle is an increase in price point, positive signal, therefore it's green, which means that over that time frame, the price point closed higher than when it opened. Bear candle is a decrease in price, negative signal, right? It's gone down in price point, so it's not a good thing, so it's red. Over that time frame, the price point has closed lower than when it opened. now that we know how to read it, how do we start interpreting what the candlestick is trying to tell us? And this is what I think is the most important part. Reading a candlestick is one thing, understanding it is another thing. This is probably the most important part. So in order for a stock price to go up, there has to be people willing to buy at the more expensive price point, which in this case means that the demand is greater than supply, which means that buyers are winning. So for example, and I don't know if you guys have had this experience, I'm trying to get an order filled. And the price point right now is $100. There's no supply left at $100. The next supply is at $101, right? In order for me to buy this one thing, I had to put $101 in. Then I'll be like, okay, I'll raise my price point, I'll buy it at 101. Now let's assume that there's nothing between 100 and 120 bucks. And I want to buy, and I really, really want to buy. And if that's the case, then I would buy it at $120, which means that the price point has gone up. When there's little supply, price point usually goes up because people would put in more money to buy that limited supply. In order for a stock price to go down, right, there has to be people willing to sell at a cheaper price. So for example, if you're trying to get rid of something, you're trying to sell something, you guys have done this, like you put it on eBay, you put it on Facebook Marketplace or whatever it is, and you set it at $100, but no one's buying, right? You drop it to 98. No one's buying. You drop it to 96. No one's buying. You drop it to 95. Someone bought it. You went from $100 to $95. That's essentially you lowering the price until someone wants to buy it. Someone ends up meeting your price point and you sold it at a lower price than what you had expected to sell it for initially. That's essentially what's happening on a market when you look at these candlesticks. Supply is greater than demand, so in order for you to sell it, you have to lower your price point. Here, because demand is greater than supply, I can charge more money, or I would have to put in more money to get what I want. I went up, I went down. It's all because of supply and demand. Okay. Now let's take this idea and look at all the different shapes and kinds of candlesticks. Candlestick comes in many shapes and forms, and they're all trying to tell us different things. And let's see if we can walk through some of them and see if we can understand what they're trying to tell us. Now here on the screen, you'll see 6 different candlesticks of different shapes and different sizes. Let's walk you through some of them. So first one right here, this would be a open at here, it would close here, it went all the way up to here, and it went all the way down to here. So what does this necessarily mean, right? So if I started at $100, went all the way up to 110, and went all the way down to 90. Let's assume that that's the price point, and it ended at 102. I would say there's a large price rejection at both the lows and the highs of the day, which means that when it reached down here, lots of people started buying and it drove the price up. When it went up here, a lot of people started taking profit and selling off in fear, and then it ended up here. So I would say this is a bullish candlestick because the body is green. However, you do see signs of indecision because the market doesn't know if this is a good price point or if this is a good price point because the market has shown a rejection of both the lows and the highs. Now let's take a look at this one, right? This one is very similar, right? The body is, we can say, maybe slightly bigger. The wicks are significantly shorter. So if this is 100 and this is 103, this is 102, this is 103, this is probably 105, this is 95. This just means, if you look at it compared to this candlestick, this means that there is slightly less rejection at certain levels. The price point didn't go up nearly as high or low on a day-to-day basis. It means that there's not much price fluctuations, which means there's not much the means that the supply and demand, I would say, is fairly equal on each side. If you want to buy it, you didn't have to raise your price point too much. If you want to sell it, you didn't have to lower your price point by too much. Again, a bullish candlestick because it's green. It ended up higher than it closed. But essentially, there is stronger, I would say, overall demand for the stock that you're looking at. Now, this one is where things get a little bit more interesting. This is where it opened, closed slightly higher. But on the day, there was this large rejection off of this daily low, and there's a slight rejection off of this high. What is this really telling you? It means that if it opened here at 100, let's assume there's 100, it went all the way down to like $85. But at 85, people were like, oh, that's a good deal. So they started buying. As more people buy, more people want to buy in, right? Because you feel like it's safe to buy in. You go all the way up to the top. Started rejecting a little bit to here. What this is telling you is that the market, although it sold off, people found that it was a good deal, bought a lot of it, and the price shot back up, higher than when it closed at. So this is a very bullish signal. You can understand why. When something sells off like this and it didn't stay cheap, it means that it's a good thing, right? People want to buy in. So the demand came in and pushed this all the way up. So this is a very bullish signal. Now let's look at this candle. This candle here, it opened up here. It opened at 90. It went all the way up to like 105. And it ended at 100. What does this mean? This is also a very, very bullish signal. Why is that? Because people are like, oh, this is a good deal. Again, similar to this right here. It's a good deal. So I'm going to buy all the way up here. And then maybe some people sold off, but not a lot. It ended up here. If you didn't have this wick right here, just get rid of this wick. This is the same idea. It would, on the day, it basically only went up. That's also a very bullish signal. This one is the inverse of this, right? So I started here. The stock price went all the way up to here, but then it sold off. People are like, oh crap, this is too expensive, or I'm a little scared. I want to make sure that I protect my earnings. I want to make sure that I make $100 in profit. So they're going to sell off, secure that $100 in profit. And then that's what happens when this starts selling off, right? It starts decreasing in price point again because more people are selling than more people are buying. And then it ends up at this close right here. If you were to only look at the color, you would think that this is a bullish signal. But in my mind, when you look at this, it's actually quite a bearish signal because you're hitting a price point where the market indicates that the price point is no longer of a good value and people are scared and people are willing to sell off what they own in order to make sure that they don't lose money. This is what this large wick here is telling me. And we'll go through the last one real briefly. This one is just basically this, just a smaller body, which means that open and close is slightly smaller than this one. Now let's take a look at bear candlesticks. Same idea. Basically, the only difference here is that the open and the close are flipped. Instead of opening lower, I opened higher. So I opened here, I closed here, but there's again strong rejection off of this top level. So this is a very bearish signal. The price point got pushed up here, but then more people started selling, and it ended up here. A lot of selling power. And so when you hear that, when you see that, try correlating that to like some of your own emotions. This is basically fear kicking in. Fear of the market tanking, fear of a pullback, or even fear of the price continuing to go down. For example, if you own stocks, you've seen this before, you say, oh yeah, the stock went all the way up, I'm good. I bought in here and the stock went all the way up here. So I bought in at 100, now it's 110. And then it's dropping. Now it's 108. You're like, oh, probably shouldn't sell. I can't sell. It's probably going to go back up 107, 106, 105. You're like, oh crap, if I keep this up, it might keep dropping. I'm going to lose my money. And so you sell at 105, right, in order to protect your earnings. So now it's a 105. You made a $5 profit. And as you sell off, the price continues to drop. And so people would then further sell off. And so this is why this wick is happening here. Now, this is the same idea here, right? This is basically not too much price movement on this one day. High, low, it closed lower than it opened. Kind of a boring day, essentially, compared to this. Not too much price movement. This and this are basically the same candlestick. A little bit of an indecision, kind of like this one too. Strong price rejection off of both sides, so the market really doesn't know what to do. The market, the buyer and sellers are both kind of fighting each other to figure out who wins. So eventually, at some point, one side's going to win over the other, and then this candlestick is either going to go up or down. The buyer and sellers are basically equal in strength. Enough sellers and enough buyers are kind of counteracting each other. It would say this is a bullish signal again. You're selling off all the way here, but then you're buying, right? And then you're correlating that to your own experience. You're looking to buy stock, was at 100, now it's at 90. You're like, okay, well, I think it's a good price point to buy. But instead of falling down to 85, it goes back up to like 92, 93, 94, 95, 96, 97. And you're like, oh crap, if I don't buy it now, it might keep going up. And so you buy it at 95 or 96. So this is what's happening here is that as more and more people come in at a higher and higher price point, it'll keep pushing the stock up. So this is basically what the long wick means. Now, if you look at this one, this is a big sell-off. Basically, I'm opening up 100 and it closed at 90, which means that along the way, a lot of people sold to make it a $10 difference. Right? So you could be one of them. You're selling, you're like, oh crap, maybe the price point's going to keep dropping. So I'm going to sell my shares in order to protect myself so that it doesn't fall to 90 and I lose even more money. All right, so let's play a game. Which one is more bullish and which one is more bearish? I'm going to give you guys two candlesticks, both a bull and a bear candlestick, and just choose one of each. Which one of these is more bullish and which one of these is more bearish? Okay, 5, 4, 3, 2, 1. All right, the answer is on the left-hand side, and this one is definitely more bullish because the price point not only ended up higher, but there's a strong rejection again off of this level. This is kind of the market telling you that this is a good price point that people were looking to buy into, and so a lot of people started buying in, and as more people started to buy in, as the stock price continued to go up, more people bought in, and more people bought in. This is a very bullish signal. Now on this side, which one is more bearish? And this one's definitely more bearish, right? This one is a strong price rejection off of a level, which means more people bought in. which is actually a bull sign. This means that it opened up here and it closed all the way down here, which means that there was no positive notes whatsoever. The buyers never outpaced the sellers. This is a very bearish signal, and this is a very bullish signal. Different candles, different wicks, but you can kind of tell as you correlate and understand what these wicks and candles are telling you, you can then understand the market sentiment. All right, so now that you understand the context, there are some nomenclature that people use when they're discussing or talking about candlesticks. I'll walk you guys through some of them real quick. Here it's gray because it doesn't really matter in my opinion whether it's a bull or bear candlestick, because the wicks here are dominating. Same with this small and big candle, because it can go either way. Hammer, this looks like a hammer, right? The hammer just means that there's a strong rejection off of this level, closed higher, much higher than the low of the days. The shooting star is the inverse. A small candle is basically the size of the candle, so this is small. It can be green or red. A small candle is just the size of this candle is very, very small, proportional to everything else on the chart. And then a big candle is basically a huge candle in size relative to everything else. Now there's one more name that you guys will hear. It's called a doji. A doji is essentially a candlestick with no body, right? You see no body. It's just a line. It basically looks like a cross or a plus sign. So candlestick basically means that it opened and closed at the same price point, indicating that there's been little to no movement during that time frame. Doesn't mean that there's no movement on the day. It just means that the market ended up at the same price point. So we can do the same thing here. The only difference here is there's no body, but the psychology still remains the same. Right? This is an indecision candlestick essentially, right? The market doesn't really know which way to go, especially if the wicks are shorter. This is what we would really call an indecision candlestick. So just imagine this wick is like here, a quarter of the size, which means that the market really didn't move much at all. Now this is the shooting star, but without the body, right? Same thing, strong price rejection off of that top level, a bearish sign. This is a strong price rejection off of a low, which means it's a bullish sign, similar to the hammer, right? Shooting star, hammer, but just without the body. So because they don't have bodies, they have different names. They're called dojis. So this is what we call a long-legged doji. This is what we call a gravestone doji. Dragonfly doji is essentially, you can see it looks like a dragonfly. Think about the hammer, but without the body. Same idea. Now let's look at some charts to see whether or not we can find some of these candlesticks on charts. Here I'm just on SPY, S&P 500, and we're just gonna see if we can find some. So if we look back here, right, this is a large body, a candlestick, red large body, which means that this is a large selling power. This is a large body as well, but you can tell there's a wick and a wick, right? And so here you can see there's a strong rejection off of this price point, right? It went up from 226 all the way up to 250, which means this is a very bullish sign, right? It's a strong signal that people are trying to buy in at its time frame. Same with this one here, right? It's another strong bullish signal, 257, ended at 275 with a rejection off of 248. And on the inverse, like we just talked about, this is a bearish signal. It opened up at 323, ended at 284, and then it closed at 295. Another big move down. Here you can see this is probably like an indecision candlestick, right? The market's trying to figure out if it's going to go up or down. Opened up at 227, closed at 268, but it went all the way down to 246, went all the way up to 286, right? The buyers and the sellers are fighting itself out. In this case, the sellers are winning slightly. Here's again, you can see this is like a hammer. Opened at 289, it went all the way down to 272, and it closed at 284. Longer bottom wick than the higher wick. Large body here, large body here. You can see that same. Again, this is this is almost a doji if you were to zoom in just slightly right here. This is kind of like a doji. Do you see that? Open and close around the same price point. Again, almost a doji. A doji right here. This is what we call a indecision doji. Right, this is a hammer, right? Large body. Yeah, just looking around, you can see a lot of the candles that we looked at. We can go to another one. Let's go to Amazon. Large body here, right? Large body. Shooting star right here, where my cursor is. You see that? This is kind of like a hammer, right? Large wick, not a big top. A doji right here. Large body again, right? Close to a doji. This is a shooting star right here. You see a lot of these candlesticks, right, on here. A lot of those names that we just talked about, all of these candlesticks are telling you a story. Our job is kind of interpret what's happening and see if we can understand here. This is another doji right here. There's a doji right here, long-legged doji. We can even go to Tesla, right? Whoa, wow, look at this one. What is this one telling you? There's maybe not even a name for this, but you can see it was at 800, went all the way down to 530, right? What is this telling you? This is crazy. Strong price rejection, right? It opened here, went up, went all the way down here, and it closed here, right? Strong price rejection. That's a really, really big signal. Large body again, doji, hammer, large body, right? You see all of these, a doji. Understanding candlesticks is great and all. Like, you can understand how things have moved, how things have transpired. In the next video, I'm going to show you guys the true power of candlesticks, where you can start combining candlesticks to form patterns. Combining candlesticks to form patterns, you get a larger idea of what's happening on the market. There is a lot more data information from both an emotional and a concrete data perspective about what's happening on the market. So if you have two dojis, two bearish dojis and two bullish dojis, they mean different things. If you have a large wick with a small body combined with a large body and a small wick, then that also means something else. And so by combining candlesticks, that's actually one of the powers of candlesticks. So by combining different time periods and different patterns, you can understand the market psychology a lot better than by just looking at one candlestick by itself. On whatever platform you guys are using, I use Thinkorswim right there, but you guys can use Webull, TradingView, whatever platform that you guys use. See if you guys can spot some of these candlesticks that we just went through. And then challenge yourself to see whether or not you guys can understand, at least on that candlestick, what that candlestick's trying to tell you, and see if you guys can even correlate that, like we've done here, to some of your own experiences to understand the emotional and psychological context. But yeah, so let me know down in the comment section below what you guys thought, what you guys think. If you guys have any comments, if you guys liked it, please press the like button. If you guys really enjoyed it, please consider subscribing. And until next time, peace.